Thanks for the opportunity, and thanks for everyone here on this webinar for spending your evening with us to learn a little bit more about this project called as Quinn, which is based out of western part of Houston, specifically in Westchase area. As with every project, we always want to show you this disclaimer. I'll give you about 30 seconds to read through it. But briefly, this is a 506B syndication open to sophisticated and or accredited investor with a relationship with sponsors or co-sponsors. So we'll take a quick pause. All right, moving on. So as Ravi introduced us, I am Sudhir Joshi, and with my business partner Yash, we are the lead sponsors on this project. We have been Houstonians for more than 20 years and have worked in several aspects of real estate, primarily in Kiev, land acquisitions, and ground-up constructions of townhomes. And we have been investing into apartments from 2016 in various capacity. And our investments so far have gone into more than 4,000 units. And we are deep-rooted in Houston. Yes, you want to say something?
Yeah, like you said, you have mentioned everything about us. And I know Ravi too. We are neighbors too. I and Ravi are neighbors, so I know Ravi for more than 18 years, I believe, in addition to what Sudhir already mentioned.
Okay. And other than land holdings, multi-families, we also hold a fairly large portfolio of single-family homes that we manage under Namma Rental Homes. So in this project, we are co-sponsored by 4 people, one of them being Ravi himself. So as you all know, Ravi, he has been involved in various syndications in Austin area, and he has passively invested in several of the deals. So he is no new name to the people that are on this call. Now, at a very high level, the project itself, we are calling this project as Corridor at Westchase. And this project has 369 units. It was built in 1979. We are purchasing this particular project for $41 million. We have included a rehab budget of $2 million. From a loan side of things, we are getting a loan of about $32 million. Loan to cost is 75%. We are raising $14 million in equity to close this loan. And this is a non-recourse bridge loan. So for any investor coming into this project individually, the minimum investment is 50%. The interest rate that we have locked is 4.25%, which is a variable rate, plus a variable called SOFR, which is an index that will go on top of 4.25%. This is a 5-year interest-only loan, starts with an initial period of 3 years, and then we can extend 1 year at a time to a maximum of 5 years. From a cap rate assumption, we are assuming to exit this project at a conservative 5.5 cap. From a returns perspective, we are looking at returning our investors anywhere between 90 to 125% of their invested amount. We are giving a 8% preferred return. The GP split is 80-20. and the annual average return is 20% on this project. A high-level business plan for us is basically to rebrand. It's currently called as Quinn. We are rebranding it to Corridor at Westchase. We want to boost curb appeal. We want to add amenities like the dog park, play area, to make it a nice living for our residents. We want to upgrade the interiors and various other things to boost other income. And we strongly feel if we achieve the organic rent growth with the rehab rent growth, we should be able to accomplish about $9 million in value in about 2 years. Now, a little bit more detail about the property itself. Essentially, before we get into any project, I mean, we had looked at a whole lot. So before we come in here, we have underwritten more than 40 deals, and we felt this is diamond in the rough that we found, and this presents a great return on our investment. And this is in an amazing location of Houston to Westchase district. So we took this as an opportunity to get it on contract and speak to investors to get them into the project. So as I mentioned a little bit of this thing, I mean, it's built in 1979, 369 units, 809 square feet on an average. As of 3/16, the occupancy was 90%, 90.8. And as we can see, we are here in June, the occupancy has increased to 96%. The property is very strong and continues to gain strength. So it's a fantastic opportunity for us. It has 26 buildings overall, 1 fitness center, and 3 laundry facilities. From a school district's perspective, this is zoned out to Houston ISD. Elementary school is SQ, middle is Revere, and high school is Westside. And I am fortunate enough to send my kids to SQ as well as Westside High. It's a pretty decent school for families to send their kids. I have a little bit of personal history to this property as well. I mean, I used to live in Energy Corridor, and I used to drive by this property literally every day when I used to go to work at Home Depot. So I've seen this property enough in the last 10 years or so. So good property, good opportunity for us to get in. A little bit about the location, where it is placed. If you're from Houston, you know Westheimer very well. So here, there is, Westheimer is literally about half a mile away. There are several nearby employers. Energy Corridor is very close to us. We are very close to Highway 6 on one side, Beltway 8 on the other side, then I-10. And just go a little bit north of Westheimer. Sorry, south of Westheimer, you get West Park Tollway. So very closely connected to all the major roads, very closely connected to major employers, including energy companies, some of the technology companies like BMC, Bill.com, HomeDepot.com, about 40-45 minutes to the George Bush International Airport, and about the same, about 40 minutes or so to Hobby Airport. So amazing location for anyone that's going to live in this particular area and in this complex. Another look of the sky view of the same complex in terms of where it is located and the major employers within 30 minutes or so from this particular property. Again, with the gas prices going high, employers are asking their employers to come back to work. I think people would want to live closer to their work. So I think this provides us with another excellent view of what apartment living is going to look like in the foreseeable future. Now, a little bit about what is inside this particular complex. So some of the units that you see on the picture here are model units. Basically comes with, these are, you can also consider these are higher end units. Comes with typical hardwood flooring, stainless steel appliances, backsplash, and they either come with granite countertops or resurfaced countertops. The premium always will come up with granite countertops. And most of the premium finishes also include a new cabinet doors to make the kitchen look great. A few more pictures here that show various levels of upgrades. On the left top, again, this is one of the premium finished apartment. The only thing that is missing here from this is it does not have granite. The one below on the left has all the premium finish. It includes black appliances and granite. And the one on the right, it has bulk of the upgrades, including a resurfaced countertop, but includes classic appliances. So we have various level of upgrades that are part of this complex. And with our ownership, we want to increase revenue by providing some consistency as well. Again, one more look here. Again, similar show. Basically, white cabinets, granite, black appliances, and gray cabinets here with granite. And then, as you can see, resurfaced cabinets, resurfaced countertops, and grayish cabinets here. So you can see the flavor, but overall, these are some things that we are going to improve on with our ownership. Another set of various level of upgrades that we are able to show you here. So the target for us is to rehab the units that are in this condition. So we have 49% units that have upgrades at various levels, and we have another 51% units that can be upgraded to the level that I showed you a few slides back. So a lot of opportunities for us to go and clean up some of the units and to improve the rents. Now coming to the floor plans, this property has 7 different floor plans. It has 2 one-bedroom plans. The smallest one bedroom is 690 square feet. The larger one is 730. The 2-bedroom, there are 2 plans. 2-bedroom, 1 bath. It comes with 900 square feet, and 2-bedroom, 2 bath comes with 1040 square feet. And we have 1 3-bedroom, 2 bath, which is 1150 square feet, and 2 efficiencies, the smallest being 380 and the larger one being 475. So overall, 7 different floor plans for our clientele to choose. Now, looking at the community amenities, this provides the typical amenity that any apartment complex of the age ends up providing. So as part of our ownership, other than what it already has, we want to give the tenants a dog park, a play area, and some kind of gazebo grilling area for them to come in, get the community feeling, and build that camaraderie potentially with the neighbors. So those are something that we want to do as part of our CapEx to improve the living of the people that are in the complex. Interior, again, pretty typical You get various levels of finishes. You typically get a nicer appliance package for the upgraded ones, whether it is black or stainless steel. And you also will get two different levels of countertops, either a resurfaced countertop or granite countertop. And again, with our ownership, we will be changing some of those fixtures as part of the unit terms, so that again, you give modern amenities to everyone that is going to come in and lease those apartments. Now, a little bit about history of this and why we feel this project is a great opportunity for us. This was bought in 2008 by a group called Casero Group. They are based out of Austin. And Casero Group came in with a joint venture partner that was based out of California. And the agreement they had as part of this acquisition was the JV partner based out of California would end up property managing this particular complex. So they took over the property management, and they had a fairly large rehab budget with them, close to $7 million. So they started taking down the units. Taking down means, they once the tenants left, they wanted to go do a full-blown rehab. And they started doing that sometime in 2019. And the rehab, they took down a whole lot of units, but they did not turn it back on. After the rehab was complete, they somehow mismanaged their inventory and they did not rent it out. And we saw COVID and supply chain issues. Even though some of the units were ready, they did not have the appliances, because these guys, what they did was they dumped the appliances that were working to get new ones. The appliances did not come in and they were not able to rent. So they literally dragged the property occupancy to about 60%. And then there was a lawsuit between Casero Group and their JV partner to get rid of that property management, and it was taken over by Casero Group with a property management company called Clear PM. So Clear PM took this property from 60% to all the way to 96.6 as of last month. It is continuously becoming stronger and stronger. And as part of the takeover, they had to give more incentives to bring people from 60 to 80, 85. So those incentives will burn off with our ownership, and we'll be able to achieve a much larger income than what we are seeing today on this property. A few rent comparisons for you. As you can see, the overall averages in that area is $1.31, and the current rent that is charged for anyone coming into corridor at Westchase is $1.17. So there is a lot of opportunity for us to, again, bring the rent to market and burn off those discounts that have been given to the existing tenants. A few sales comps. This chart is coming from CoStar. Again, there are about 24 sales that have happened in that area. Overall average of about $47 million with per unit sale at 153. These are again various year builds, so it is not granular enough to exactly match our property, but gives you a broad range of what is being sold in that area. So a few close to real examples with our property. And as you can see at the bottom, we are buying it at 110 per door, and the averages are somewhere in the 135 range. So this is the chart that shows the unit mix and what we feel as the rent that we are going to chase. So the rent that is currently being charged is $1.70, and the rent that we are proposing as part of our ownership is $1.30. So from our takeover, we want to start raising the rent to $1.30. So by end of the year into next year, we will reach per the pro forma that number. But good news for our investors is that the newer rents are already accomplishing $1.36 per square feet, which is much higher than what we have estimated as part of our numbers. So these numbers are still conservative in their own ways, but we want to keep it that way for things that might come in our way that are unforeseen. So we are going to keep these numbers the way they are. Now, regarding our business plan, of course, we want to go in and value add. So there is lots of things that you can do organically without even touching anything, right? We have 49% units that are already there that are with various levels of rehab. So if you just go and spend $500 with some paint and stuff, organically, these units will still rent at a higher rate. But we have a $2 million rehab out there to increase it much further, to bring the property to a pristine condition inside and out. So what we want to do is we want to, first of all, rebrand. We want to take away that legacy name of Quen and give it Corridors at Westchase. We want to add a new signage for the people that will be driving by that area to see the difference. We are going to spruce up the leasing office, and we are going to renovate around 200 units as they turn. We are not going to go and kick out the tenants to turn these units, but as they turn, good tenants we'll try to keep. The average tenants we want to get rid of to bring in newer tenants. We want to improve the exterior of the property. That includes landscaping, pool, foundation repair, parking lot updates, restriping to improve the curb appeal. We want to add community amenities like play area, a gazebo, and a dog park. We are also going to add security cameras to overall enhance security for the residents and also for us as ownership team. We want to add a private yard, a reserved parking, washer dryers to boost our other income. Obviously, we do this to increase income, and these are our various mechanisms to go add that additional income to the bottom line. So overall, I mean, doing the things that are simple in nature. We are not really trying to do anything complicated here. We want to increase the rent organically. We want to increase the rent with rehabs. We want to increase the rent by adding other income. Overall, our goal is to increase the value of the property. By doing these simple things, we strongly feel that we will be able to accomplish $9 million of value in a very short period of time. And when I say short period of time, I think within 2 years, we should have accomplished that additional value for this property. So regarding exit, a lot of questions will be around, okay, if I invest now, what will happen? So for a minimum, we always propose investments as a 5-year hold. But the goal will always be to provide investors with cash as soon as we possibly can. That is the safety net. So in our scenario here, we want to sell in year 3. 2 years, we are going to do all the hard work. 3rd year, we are going to sell. If the market caps allows us, and if we can hit a minimum of 20% return for our investors. So if you are going to exit in year 3, we should be at least be able to give you about 40% or more of your invested amount. So it can be between 40 and 60, depending on when we exit in year 3. In scenario B, assuming we cannot exit for whatever reason, we will extend the loan. We will extend the bridge to the 4th-year extension. And in scenario C perspective, if the rates are stabilized, normalized, then we can go into an agency debt and we can run this property for a long period of time. But generally, A and B and C, one of these things will be used based on the market conditions at the time. Now, why invest in a property like this? You might be asking this question to yourself. So let me try to pare it down. First of all, this property will provide you an approximate 2x return on your invested amount, and it will also provide a cash flow. So every quarter, there's a dividend payout that is going to come to you, which you can use for some of your expenses. We have done diligent underwriting. So we have used conservative revenue growth with focus on that income growth. We want to reduce the economic vacancy so that ultimately the value continues to increase in terms of our net operating income. We are well capitalized. We have $2 million in CapEx budget, and we have a good team together that is capitalized as well, just in case of additional dollars needed. We spoke enough about this location. I mean, overall, very good location for someone living that is going to work in that area. And overall neighborhood out there has a 92% occupancy, and the growth projections for rents are at around 6%. And we talked a little bit about us. I mean, we are an experienced team with very strong property managers that is going to be working with us to deliver on this project. And we spoke a little bit about business plan and also exit strategy. So we always want to keep our investors first in anything that we do with our exit strategy. So we did various levels of financial stress test on this project. Essentially, for us to break even, we want to have 75% people living in the complex and paying the rent. So the current occupancy as it sits is at 96%, 96.6. So we have enough cushion at this time. If 20% of people move out of the complex for whatever reason from year 2 through year 6, again, this deal will still cash flow with a DSCR of 1.14 in year 2 to 1.25. And if we lose 8% in projected revenues, again, the deal will work with year 2 at 1.22 and year 3 at 1.33. So there's cash flow coming. And interest rate is a big thing. So if interest rate goes to 7%, what will happen? Again, the same thing. We will be somewhere in 1.2, 1.3 range in year 2 and year 3. So overall, with various stress tests, we were able to prove out that we can sustain these shocks if they come our way during our ownership. Now, what are we going to do with our capital? We have allocated $2 million capital. Out of $2 million, we are going to spend $1.3 million in interior rehab, various capex items like flooring, countertop, appliances, and washer dryers. And we are going to put $680,000 in exterior rehab. So again, these things include signage, parking lot improvements, pool improvements, private yards, and things of that nature. So overall, we'll be spending these dollars in the first couple of years to make the most for our tenants and also for ourselves to grow that income. So we talked a little bit about the purchase price. The total amount that will be financed on this one is $32 million. That is something that the bank is willing to lend us. We need a total of $14 million to close on this particular loan. And as you can see, the breakdown, about 10.6 going into down payment, 2.2 going into closing cost, 500 in escrow, 700 in working capital. And the $2 million that you see here, this is a finance rehab coming out of this $32 million. So that's how these equity is broken out by their corresponding usage. Now coming to financial analysis, this is how we have projected the rent. So first year, we will start off with $2.3 million. And if we continue to run this property with our projections at the end of 5 years, we will reach a net operating income of $3.3 million. So overall, a steady growth that we are going to look for in increasing the value. So in terms of a sample investment, if you were to invest $100,000 into this project, what would happen? So the first year is always going to be a little bit slow. We are going to start off with about $6,000 in dividend payouts. And year two, we are going to give an 8% dividend payout paid on a quarterly basis at 2% each quarter. Third year is the year where we plan to refinance. So it can be somewhere early to middle of third year. We are going to try to refinance. If we refinance, we should be able to return about 40 to 50% of your money in that refinance event. And if you continue to run this property, another 8% dividend payout in year 4 and another 8% dividend in year 5, with a total payout for all 5 years, including your dividends, to be around $210,000. These numbers always shift a little bit. That's why I put a chart down in terms of what we feel as a range of returns. In our best case, if we exit at 5 cap, you're looking at about 28% in total return. Most likely, if we exit at 5.5, we are looking at about 21%. And on the worst case, if we exit at a much higher cap, 6%, then you're looking at 16% overall return. But we strongly feel the number that we have here at the top are closer to what we feel we'll exit at. Fee structure, how are we going to break out these various splits? So we start off with 80-20. So 80% is given out to every limited partner, and that is going to be part of this journey. And then 20% is going to be to the sponsors on the deal. And there is a 8% hurdle of preferred return as well on top of this. Then there's a sponsors investment we are going to be putting in. And this has actually changed as of yesterday evening. I need to change it. Sponsors are going to invest 15% into the project. And acquisition fee is 1%, asset management is 2%, and property management is 2.5%. Acquisition timeline, we are right here with our due diligence period completed. We want the subscription to be closed by July 15th, and we target this closing to be early to mid-August. Now, how to invest? These are series that you can look at. Essentially, this is open for accredited or sophisticated investors. There's a link to the portal. And then, of course, you can log into the portal and sign up and finish the paperwork and wire your funds. We are accepting IRA funds as well as part of this investment. In terms of closing and reporting, expect monthly reports from us. We normally have to send out a report to you, the lender, around 15th of every month. We typically send out reports around the same time to our investors as well. We are very much accessible. If you ever have a question, feel free to contact either me or Yash. Expect your first distribution after second quarter, and expect distribution every quarter then after. That is the plan for returning your dollars. With that, I am closing this presentation. I really want to thank you for your time again this evening, and I will stay back to answer any questions that you might have.